In the grand chronicle of financial markets, the legends we study are often figures of intuition, of contrarian insight, and of profound psychological fortitude. They are the operators who developed a feel for the market's irrational currents, the investors who saw value where others saw ruin. Their success was the triumph of a uniquely human form of genius. But this is not that kind of story. This is the story of a man who looked at the chaotic, story-driven world of Wall Street and saw it not as a psychological drama, but as a complex data problem to be solved. He did not seek to understand the market's narratives. He sought to find the hidden mathematical code buried beneath them. His name is Jim Simons, and his story represents a complete paradigm shift, a radical break from every legend who came before him. This is the story of how a world-class mathematician and Cold War codebreaker rejected the entire philosophical basis of traditional investing to build the single greatest money-making machine in modern history. The Medallion Fund, the secretive centerpiece of his firm, Renaissance Technologies, has generated a track record that defies belief, an average gross annual return of approximately 66% for over 3 decades. This is not the story of a man who learned to play the market's game better than anyone else. This is the story of a man who proved the game itself was different than anyone had ever imagined. In this first part, we will deconstruct the origins of his unique worldview, exploring the life of the man before he became a financier, and the revolutionary scientific culture he built to wage a quantitative war on Wall Street. To understand the architect of the Medallion Fund, one must first understand the life of Jim Simons before he ever placed a trade. His journey did not begin on Wall Street, but in the abstract and rigorous world of mathematics. He was a prodigy, earning a bachelor's degree in mathematics from MIT and by the age of 23, a PhD in the same field from the University of California, Berkeley. His early career was that of a brilliant academic, a geometer working on the highest levels of theoretical math. However, his path took a decisive turn when he was recruited to work for the Institute for Defense Analyses, or IDA, in 1964. The IDA was a highly secretive elite research organization funded by the National Security Agency. Its purpose was to bring together the nation's brightest mathematical minds to tackle the most difficult problems of national security during the height of the Cold War. Simons was not hired as a financier. He was hired as a codebreaker. His work at the IDA is a critical and often overlooked chapter in his story, as it was the perfect training ground for his future endeavors. His job was cryptanalysis, the science of sifting through massive streams of seemingly random, noisy data to find hidden patterns, weak signals, and non-random structures. He was, in essence, looking for the ghost in the machine, the faint, exploitable signal buried beneath layers of intentional obfuscation and random noise. He became a world-class expert in pattern recognition, statistical analysis, and signal processing. For Simons, the market, with its millions of daily price ticks and its cacophony of news and information, was simply another, more complex, encrypted signal waiting to be deciphered. This experience fundamentally shaped his worldview. While traditional traders saw stories and emotions, Simons saw datasets and potential algorithms. After leaving the IDA, he returned to academia, becoming the chair of the mathematics department at Stony Brook University. It was here that he did some of his most celebrated work, collaborating with the renowned geometer Xing-Shen Chern to develop the Chern-Simons theory in 1974. This highly abstract work in theoretical physics and geometry further cemented his reputation as a first-rate mathematical mind. It also demonstrated his comfort with navigating complex, multidimensional systems, a skill that would prove invaluable later. By the time Simons decided to leave academia and try his hand at trading in his early 40s, he was not a novice looking to learn the game. He was a world-class expert in a set of analytical tools that were almost completely alien to the Wall Street of the 1970s. He did not come to Wall Street to learn its rules. He came to apply his own. Simons' initial forays into trading began with a more traditional approach. he attempted to trade commodity futures using fundamental analysis, studying the supply and demand dynamics of sugar and soybeans, and forming macroeconomic views. He was moderately successful, primarily because his mathematical mind was adept at modeling these relationships. However, he quickly grew disenchanted with the discretionary fundamental approach. He found that his own emotions could still override his analysis, causing him to exit a good trade too early or hold a bad one too long. He realized that a compelling story about a future harvest or a shift in currency policy was not a statistically verifiable edge. It was still, at its core, a narrative, a guess. This realization led him to a profound philosophical break with the entire tradition of Wall Street. He came to believe that the human mind was simply not built for making consistently rational, long-term financial decisions. It is too susceptible to narrative bias, to emotional swings, and to the random reinforcement of bad habits. A discretionary trader who makes a lucky bet for the wrong reasons can be rewarded, ingraining a flawed process. A trader with a sound thesis can be shaken out of a position by a meaningless news headline. For Simons, this was not a robust or scientific way to operate. He formulated a grand hypothesis. He believed that in the vast, noisy dataset of historical market prices, there must exist short-term, statistically significant non-random patterns. These patterns, he reasoned, would be too small, too fleeting, and too complex for the human eye or mind to ever detect. But they could theoretically be uncovered with sufficient computing power and the right mathematical models. This was the birth of Renaissance technologies. In 1982, he founded his firm not as a traditional hedge fund, but as a quantitative research laboratory. The most revolutionary aspect of Renaissance was its hiring policy. From the beginning, Simons instituted a strict rule. He would not hire anyone with a background in finance or from Wall Street. He did not want their preconceived notions, their ingrained biases, or their bad story-driven habits. Instead, he recruited a completely different kind of mind. He hired mathematicians and physicists from top universities, statisticians and signal processing experts from the world of telecommunications, and cryptographers and language translation experts from his old colleagues at the IDA. He was assembling a team of pure scientists, people who were trained to find weak signals in noisy data, whether that data came from a distant star, an encrypted message, or the price of wheat futures. The culture he fostered at Renaissance was equally unique. It was not the star trader culture of a typical hedge fund, where individuals with big egos made big discretionary bets. It was a collaborative, academic, and intensely secretive environment, much like Bell Labs or the IDA. All research was version-controlled and peer-reviewed. Every proposed trading signal or edge had to be supported by rigorous statistical evidence. It had to be back-tested across decades of historical data. And, most critically, it had to be tested out of sample on data it had never seen before to ensure it was not just a product of curve fitting. Ideas were judged solely on their statistical merit. The system, the collective model, was the star. This scientific, evidence-based culture was the foundation upon which he would build his machine. The edge that Simons and his team of scientists sought was fundamentally different from the edge of any other legend we have studied. They were not looking for grand economic insights or deep fundamental value. The signals they found were tiny statistical anomalies. Their models were built on thousands of these small, uncorrelated signals, which could be anything from short-term mean reversion patterns to subtle relationships between different securities, to patterns in order flow or seasonal and calendar-based quirks. The edge of any single signal was minuscule, barely better than a coin flip at 51%. But the genius of the Renaissance approach was in finding thousands of these 51% edges that were independent of each other. By weaving them together into a single, massive, nonlinear ensemble model, they could create a highly accurate, short-term predictive system. Their strategy was not to be right big, but to be right slightly thousands of times a day. To fully appreciate the radical nature of Simons's scientific paradigm, one must understand the world of intuition and gut feel that it sought to replace. That world of discretionary speculation, of fear, greed, and the feel of the tape, is timelessly captured in the classic work on market psychology, Edwin Lefebvre's Reminiscences of a Stock Operator, based on the life of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. Simons's entire philosophy was an attempt to replace the subjective art described in this book with the cold, hard logic of statistical science. This sets up the ultimate philosophical battle for the soul of the markets. Are markets at their core a story of human psychology, a grand narrative of fear and greed best understood through the lens of history and intuition? Or is that all just noise and the true reality is a complex data problem to be solved by mathematics? As Jim Simons contends, we want to hear from you. Which paradigm do you believe is more powerful and more accurately describes the reality of today's markets? Let us know your thoughts in the comments. The answer for Jim Simons was clear. He believed that with enough data, enough computing power, and enough brain power, the market's code could be broken. The culture and the people were the first part of the equation. The second was the creation of a machine, a system to execute their findings with a level of speed and discipline that no human could ever hope to match. We have now established the why of the Renaissance method, the philosophical rejection of traditional finance and the embrace of a purely scientific approach. In the second part of this analysis, we will deconstruct the how. We will open the black box of the Medallion Fund as much as is publicly known, and explore the specific strategic pillars that make it the single greatest money-making machine in modern history. In the first part of our analysis, we established the revolutionary philosophy of Jim Simons. We explored how his unique background as a world-class mathematician and a Cold War codebreaker led him to reject the entire narrative-driven paradigm of traditional Wall Street. He concluded that human intuition was a flawed and unreliable tool for navigating the markets. His solution was to build a new kind of firm, Renaissance Technologies, based not on financial expertise, but on a rigorous, collaborative, and purely scientific research culture. We saw how this team of mathematicians and physicists was assembled not to understand the why behind market moves, but to find statistically significant non-random patterns in the raw data of price history. Now, we transition from the philosophy to the machine itself. This second part is a deconstruction of the Medallion Fund, the legendary and intensely secretive fund that is the practical application of Simons's worldview. While the precise details of its proprietary algorithms are one of the most closely guarded secrets in all of finance, decades of observation, regulatory filings, and the accounts of former employees have allowed analysts to piece together a clear picture of the core strategic pillars that drive its unprecedented success. We will now open this black box as much as is publicly possible, exploring the nature of Medallion's edge, its unique portfolio architecture, its obsession with execution, and its ironclad approach to risk. This is the anatomy of the single greatest money-making machine in modern history. The first and most fundamental pillar of the Medallion strategy is the nature of its edge, which is found in a very specific and unconventional time frame: short horizon speculation. This is the first and most critical distinction between Renaissance and nearly every other legendary investor. They are not attempting to do what Warren Buffett does: identify a great business and hold it for 10 years. They are not trying to do what George Soros or Paul Tudor Jones do: formulate a grand macroeconomic thesis that will play out over many months. The Medallion Fund operates in a time horizon that is typically between 1 and 5 days, a niche that is too short for traditional fundamentals to matter. and historically was too long for the pure, high-frequency trading strategies that operate on microseconds. It is in this no-man's land of time that they found their most fertile hunting ground. Their entire operation is a relentless hunt for thousands of tiny, temporary, and statistically significant market inefficiencies. These are not grand, directional, big calls. They are small, repeatable patterns that are invisible to the human eye but can be detected by sophisticated mathematical models. While the exact signals are secret, their general nature is understood. A major component is mean reversion. This is the statistical tendency for an asset's price after an extreme move in one direction to revert back towards its recent average. Medallion's models are designed to identify these extreme short-term dislocations and bet on their regression to the mean. Another key strategy is cross-sectional statistical arbitrage. This involves identifying a stable historical relationship between two related securities, for example, two oil companies like Shell and BP, or two technology rivals like Intel and AMD. The model constantly monitors this relationship. If one stock moves up significantly while the other does not, temporarily breaking their historical correlation, the model might automatically go short the outperformer and long the underperformer, betting that their relationship will soon converge back to its historical norm. Beyond these broader strategies, the true power of the Medallion machine lies in its ability to detect and exploit thousands of microsignals. These are tiny, often fleeting, statistical anomalies that would be considered random noise by any human analyst. This can include subtle seasonality effects, like the tendency for certain stocks to behave differently on a Monday versus a Friday, or at the end of a month versus the beginning. It can include market microstructure effects, such as patterns in the bid-ask spread or the size of orders in the queue. It can include patterns in order flow, identifying the footprint of large institutional buyers or sellers. It can also include quirks based on calendar events or known behavioral biases. The genius of the Renaissance approach is the understanding that no single one of these signals is powerful enough to be a strategy in itself. The edge of any individual signal is minuscule, barely better than a coin flip at, say, 51%. A strategy based on one such signal would be quickly arbitraged away or would fail during a change in market conditions. The true enduring edge of the Medallion Fund comes from its ensemble approach. Its master algorithm is not one simple model. It is a massive, non-linear combination of thousands of these weak, uncorrelated signals. The system weighs and synthesizes these thousands of tiny pieces of evidence to generate a single high-probability forecast for an asset's price movement over the next few days. It is like weaving thousands of individually weak threads into an unbreakable rope. This is the nature of their edge, a pure statistical and data-driven speculation on short-term patterns that are completely invisible to any human-based methodology. The second pillar of the Medallion strategy is its unique portfolio architecture, a system of market-neutral engineering designed to isolate these tiny signals from the chaotic noise of the overall market. To understand this, one must first understand the concepts of alpha and beta. Beta is the return an investor gets simply from being exposed to the general market's movement. If the S&P 500 goes up 10%, a simple index fund will also go up roughly 10%. This is beta. It is easy to capture, but it comes with all of the market's inherent risk. When the market crashes, so does your beta. Alpha, on the other hand, is the holy grail of investing. It is the skill-based return that is completely independent of the market's direction. It is the pure profit generated by a manager's unique edge. The entire structure of the Medallion Fund is designed to systematically eliminate beta and all other unwanted risks, leaving behind only a pure, isolated stream of alpha. They achieve this through a sophisticated market-neutral approach. The fund's portfolio consists of thousands of simultaneous long and short positions that are carefully balanced to maintain an overall market exposure, or beta, of close to zero. For every long position they take based on their signals, they are likely taking a corresponding short position in a related security or a market index to hedge away the general market risk. This means that if the entire stock market were to crash by 20% on a given day, the Medallion Fund, in theory, would be largely unaffected. Its longs would lose value, but its shorts would gain a similar amount, neutralizing the impact of the market's overall direction. But their hedging goes far beyond simple market beta. Using their immense database and analytical power, they systematically neutralize their exposure to dozens of other known risk factors. They are not making a bet on the technology sector versus the energy sector. Their long and short positions are balanced to eliminate any sector-specific risk. Their global portfolio is hedged to eliminate country and currency risk. They even neutralize their exposure to well-known academic factors like value, growth, or momentum. The goal of this meticulous engineering is to create a portfolio where the only remaining source of profit or loss is the performance of their thousands of tiny proprietary alpha signals. This is why the fund was able to generate a reported net return of over 80% in 2008, a year when the S&P 500 crashed by 37%. While the rest of the financial world was collapsing under the weight of negative beta, Medallion's return stream was almost completely uncorrelated. It is the financial equivalent of a sound engineer using a bank of highly advanced filters to isolate a single, pure musical note from the deafening noise of a chaotic orchestra. The third pillar of the Medallion machine is an obsessive focus on execution and cost modeling. Simons and his team understood a critical truth that most traders ignore. At the short-term horizons and with the razor-thin edges they were exploiting, transaction costs are not a minor detail. They are often the difference between a profitable system and a losing one. An alpha signal that predicts a 0.1% price move is completely worthless if the cost of executing the trade, including commissions, fees, and most importantly, market impact or slippage, is 0.15%. For this reason, Renaissance Technologies became as much of a world-class execution technology firm as it was a research firm. They invested enormous resources into building their own proprietary execution algorithms. When the system needs to buy or sell a large position, it does not simply send one large order to the market, which would alert other participants and cause the price to move against them. Instead, its algorithms break the large order down into thousands of tiny child orders. These small orders are then fed into the market intelligently over time, often disguised to look like random noise in order to minimize their own market impact. They also developed a sophisticated internal crossing engine. With thousands of different models running simultaneously, the firm often has one model that wants to buy a security at the same time, another model wants to sell it. The internal system can cross these orders with each other without ever sending them to a public exchange, dramatically reducing fees and eliminating market impact. Furthermore, their research process is unique in that it is fully integrated with a granular model of all conceivable transaction costs. They model exchange fees, borrowing costs for short positions, and most importantly, the statistical probability of slippage under different market volatility regimes. A potential new signal is only considered viable if it demonstrates profitability after all of these realistically modeled costs are accounted for. This obsessive focus on costs is also the primary reason why the Medallion Fund is famously closed to outside investors and why its capacity is tightly capped. Simons understood that the larger a fund becomes, the larger its market impact, and the more its tiny short-term edges get arbitraged away by its own trading activity. By deliberately keeping Medallion relatively small, he has been able to protect the performance of its unique short-horizon strategies. The fourth and final pillar of the Medallion system is its hard, systematic risk limits. This is the safety net that protects the entire machine from its own complexity and from the ever-present risk of model failure. The risk management at Renaissance is not discretionary. It is a non-negotiable part of the system's code. There are no star traders with the authority to override the system's signals based on their gut feeling. The models are trusted completely, but they are also monitored with a codebreaker's paranoia. The system has built-in automated tripwires. If a particular strategy or the portfolio as a whole hits a predefined loss limit or begins to behave in a way that deviates from its historical backtests, positions are automatically and ruthlessly cut. There is no debate, no committee meeting, and no hope that the position will come back. The system de-risks first and asks questions later. This approach acknowledges a key reality of quantitative trading: model decay. The market is an adaptive system. As more participants discover and trade a particular inefficiency, that inefficiency will inevitably disappear. The statistical edges that Medallion profits from are not permanent laws of nature. They have a finite lifespan. For this reason, a massive and continuous research effort is required to constantly find new, uncorrelated signals to add to the ensemble model, replacing the old signals as they decay. The edge of Renaissance is not in any single signal, but in the process of constant research, rigorous testing, and systematic risk control. The first step in building a successful system is building the habit of disciplined study. The philosophy of Jim Simons is not an abstract theory. It is a set of principles that requires reinforcement. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the legacy of Jim Simons and the Medallion Fund is that they represent the successful creation of a third, distinct paradigm in the world of finance. If the first paradigm was the long-term, fundamental value investing of Benjamin Graham and Warren Buffett, and the second was the narrative-driven, discretionary global macro speculation of George Soros and Paul Tudor Jones, then Simons pioneered the third: pure, systematic, quantitative speculation. His method stands in stark contrast to the others. He does not read annual reports or meet with management. His system would not know the difference between a share of Apple and a contract for pork bellies. Unlike the macro traders, he is not making grand directional calls on the future of the economy. His system is designed to be agnostic to the market's direction. His success is the ultimate proof that a purely scientific, evidence-based approach can not only compete with, but can vastly and consistently outperform the traditional human-driven methods of Wall Street. Jim Simons did not just beat the market. He revealed that it was playing an entirely different and perhaps inferior game.